All right, ladies and gentlemen, good morning and welcome to another edition of Macro Ace with your host, Tony. If you did see me on Trader TV doing a couple of interviews talking about what to expect for the Jackson Hole Symposium and what to expect from the meeting minutes, then I'm just going to give you another rundown again for the US consumer spending, which is going to be quite important for the Federal Reserve and what they might do going forward. Of course, we get Fed's Power today at 10 a.m. Eastern Time, alongside with a load of other Fed speakers as well. So, and then after that, when we get before the next rate decision, we get the CPI print, and we also get the, of course, next week we get the non-farm payrolls data. So that's going to be combined together to give the Federal Reserve a bit more of an understanding as to, a bit more of a push to go either way, maybe with a 75 or a 50, depending on what the data's like. Good morning, says the engineers. But let's go through US consumer spending. As I said, it's going to be quite key to help understand where the Federal Reserve could go in the future. So first, we're going to understand what consumer spending is. Also, just before I carry on, don't forget to share this with your fellow traders and friends of understanding economic releases, what to kind of expect as well. We will be going through the deviations too. So if you want to share this with your friends, then definitely go ahead with it. Be much appreciated. So what is consumer spending, right? So it shows how much consumers are spending on goods and services. The difference between CPI and PC price index. Don't forget we get the personal consumption expenditure index showing the change of the price of goods and services month on month and year on year with the core data as well. The only difference is with the CPI. CPI measures a fixed basket of goods for at least 2 years, whereas the PC price index can measure whatever it wants, depending on what spending looks like for the month or for the year. And then they can kind of chop and change it. So you get more of a realistic picture as to where inflation is with the PCE price index. But traders prefer the CPE price index, because that's what and also the Federal Reserve, they've, to make their decision with interest rate decisions, they've looked at the CPI and gone, okay, inflation is going too high. It may become unanchored. So we need to take stronger rate decisions of 75 basis point rate hike. So CPI, although PC is the preferred measure to look for forward guidance or look ahead of what inflation could look like, CPI can be more volatile in that regard. Also, with the PC price index, it doesn't exclude other areas, which the CPI only includes the urban areas within the US. So you get as said, a much more realistic picture of what overall inflation looks like within the US. Then if we're going forward then, as said, so PC price index includes rural areas as well as those paid by organizations that spent on behalf of households. So how does it affect the market? So this is the key thing. It can be quite tricky, but what you've got to understand is that consumer spending can be an indicator or is an indicator of how strong inflation can be or how weak, whether it's slowing down, depending on how consumers are spending. So if you have more people that are spending money on goods and services, that of course is going to lead to high demand for those. That means that there's high demand for those goods and services. And in turn, those businesses are going to have to raise their prices to try and slow that demand down in order to make sure that they have enough stock or that they're not over providing too much of a service or too many services to the customers. So that's naturally what happens within the economy of demand, of supply and demand. When demand gets quite high, then supply dwindles. And so there is a need to raise interest rates or raise prices first to try and slow down the amount of buying that there's going on. And then if it's still too strong, then you have the Federal Reserve that would jump in and say, all right, maybe we need to raise interest rates, stop the amount of borrowing that funds all that buying of consumer goods and services. So how does it affect the markets? Okay, key thing is when there's a healthy increase in personal spending, and when there's personal incomes and spending, it usually bodes well for the US dollar, right? So if you, as I said, the more spending that there is for goods and services, that can lead to higher inflation, which will lead to the central bank taking action. And when the central bank raises interest rates, that brings up the value of the dollar, the currency overall. Because the reason why the dollar would go up is because money is becoming more expensive, and you will have other people, international investors, that will say, hey, the interest rate in the US is much higher than the interest rate in my country, and so I'm going to be able to benefit from a high interest rate in the US rather than in my own nation or any other nation that I've been using to transfer money or to do business with. So that's what, so as I said, that can also mean that, as I said, international investors can jump to a rate of high interest. So when rates are raised, then you see a jump into the currency, and that brings up the value of the currency. Of course, there are short-term effects. So when you do have market expectations, and if it isn't met or if it's much higher than expected, then that's a different thing altogether. But generally, that's what happens to the currency. Now, with stocks, a higher personal income, if we're thinking about in a normal environment where there is no tightening from the central bank or no easing from the central bank and things are kind of normal, then there's no rate hikes or rate cuts. So higher personal income and spending is viewed as favorable in the stock market because that will fuel more economic activity and increase corporate profits. If you have a strong amount of spending from consumers, of course, that means you can hire more people to provide the services or make the goods that you need to make. And you can also, start to increase prices as well if there's a strong demand for it or if there's an increase in demand for it. So usually when there's no tightening, within the from the central bank, that can lead to higher corporate profits. But as we know, with the central bank, that within the tiny environment currently at the moment, that we've seen a negative effect, because that would mean that the central bank can, again, as I said, step in and raise interest rates. And I go through the deviations to kind of back up what I'm saying, so you're not kind of thinking, hey, what is this guy on about? Anyway, so bonds, so bond prices, particularly, or whether you're looking at bond prices or bond yields, you've got to understand that there's a supply and demand for bonds as well. So when the economy does really, really well and consumer spending is quite hot, then usually what happens is that bond prices will head lower and bond yields will head higher in anticipation of a rate hike or higher interest rates. So that's what usually happens to bond prices and bond yields. Now, if you get a really bad report, then what that can also mean is that your normal average trader might think, okay, things are not looking so great. Maybe the central bank won't need to raise rates that much as we had priced in. We currently have pricing in of a 75 base point rate hike from the markets. So then what could happen is that pricing in could we could see the opposite effect of that if we get a really bad personal income data. So instead, you could see bond prices going higher and bond yields going lower in anticipation of a lower interest rate. So remember, again, when interest rates are raised, it brings up the bond yields. And if the inverse happens, then bond yields start to head down. Hope that makes everything clear. I know I'm going quite quickly through it with you guys, but hopefully you guys are finding it good. Active Imelda says the way you explain these concepts really puts things into perspective. And Giri, apologies if I said it wrong, says agree. Thank you very much. So let's carry on then. So the previous report from June then. So the increase in current dollar income in June primarily reflected increase in compensation led by private wages and salaries and proprietors' incomes. So key thing is that these consumers are seeing an increase in their wages, and we know that the wages have been increasing for quite a long time. So it's made it more difficult actually for businesses to hire people because they need to kind of match what the market is looking at. So if they need higher wages, they need to raise their wages to try and pull those people back in to their business if they had left or gone to another business. Then also to add as well that the $181 billion increase in current dollar PCE in June reflected an increase of about $95 billion in spending for goods and an increase of $86 billion spending for services. So with goods, Gasoline and other energy goods were the leading contributors to the increase. Within services, it was spending for healthcare, housing, and utilities. Now, the key thing is that housing and utilities is going to be quite obvious. If people are having to pay more for their, energy at home, because there's a crippling effect that has been occurring, and it has kind of dwindled down a little bit. We have gasoline prices that have come down in the US from going from $5 to around $4.50 to around $3.50, maybe around there. Then that's going to be quite important going forward for the CPI report. If consumers are still paying, although in the last CPI report, you actually saw, last couple of CPI reports, you'd seen a, not as strong of an indicator in energy spending compared to what it was beforehand, earlier on in the year. So the key thing is that are those energy effects still lingering? Are they still quite strong? That could be something that's hinted from the last report from consumer spending. But the other key factor is that goods has seen a nice increase too. But as said, it's in gasoline and other energy goods. So think about electricity as well. That's also one thing we've got to consider too. If that's also during the summer, if that's been flying up because everyone's used their ACs, of course, you need to use, you have natural gas to power that too. So that's another thing that we've got to consider too. It might be stronger than, it might be quite strong, this report that we have. Cyric says, what are your thoughts on what Biden did regarding student loans? That I will get to in a bit. I will keep the question in the back of my mind once I've gone through all of this. So inflation at a 40-year high still, although we did see a tick down. From 9.1% to 8.5%. PC price index year on year, with a high, we'd seen it go to 6.8% versus 6.3%. Core PCE year on year was at 4.8% versus a prior 4.7%. Non-farm payrolls was smashing. It was really great. We had seen 500,000 jobs being added within the US. I remember the forecast being around 250k. So we had a really nice deviation of nearly 300, or basically a 300k deviation from the forecast compared to the actual figure. And we'd seen that really nice jump on the Dixie. We'd seen the S&P 500 had seen negative reaction from that. So that was very strong. Retail sales wasn't outstanding. It was at 0% versus 0.1%. Core retail sales month on month at 4% versus 1%, but it was better than the forecast of minus 0.1%. So that kind of helped keep the Dixie up a little bit. And then if we keep going on, consumer credit is also very key as well. 22.3 billion versus 38 billion. Unemployment ticked down after 4 months of staying at 3.6%, right? That's, so it was quite sticky. And then that's evidence of, that provides evidence of a very tight labor market, that people are trying to look for higher wages, or maybe they're, being, and you have all these jobs that are being pumped into the economy at the same time too, to try and attract more people, have space for more people for those jobs. Q2 GDP advance, or again, as we've seen a second quarter of negative GDP of minus 0.9%. versus the first quarter GDP of minus 1.6%. Remember, the Fed were, from the last meeting minutes, looking for a better than, or actually the meeting minutes before the one we recently had, they were looking for a better second quarter, or some of their members were looking for that. And we didn't get that. So again, we'd seen a negative print from Q2 GDP. We had the University of Michigan inflation expectations for 1 year. That's quite key too for today. Although we have the final data today, alongside with Fed's Powell today as well, of all days. Luckily it's a final, so we're not expecting too much of a deviation. But 1 year ahead inflation, they had people expecting inflation to be 5% versus 5.2%. And then the 5 year expectation, expecting it to tick up to 3%. From 2.9%. So more or less with the inflation expectations in the ranges of what we've seen for the past year or so. Nothing too outstanding or very worrying from the University of Michigan sentiment data that we had seen. So more or less, as said, in line with expectations, not a huge deviation. We didn't get figures like 6% or was really smashing out the expectations. So that's also quite a mixed picture there, but not too worrying or in change of sentiment. All of these indicators I'm showing you are very key to understand where inflation could be headed. So if jobs are quite strong, that means there are more people, that there's an opportunity for more people to work, and that can lead to people getting a wage and using that wage to spend on goods and services, which can lead to higher inflation. Retail sales, again, are people going to the stores, or are they going to Amazon and purchasing a load of products? Again, that's going to be quite key too. And excluding automobiles, so of course, automobiles makes up a very big part of the retail sales report. So excluding that, if that was better than expected in the last report that we had, then there are some other aspects within that report, particularly in the services side and hospitality, that are going to, not hospitality. You have restaurants, people going out more into the nation. That's going to be quite, it could be a very worrying thing if you're looking for the Federal Reserve, or if you're looking for a peak in inflation or continued downward movement in inflation. That's not going to happen. Then that could be more of a difficult scenario as one thing to be aware of. So other things and triggers then for the data. So we're expecting according to economists then, what are they looking at? What are they expecting for the data? So they're expecting a high estimate of 1.1% with a low estimate of 2%. So a 0.6 deviation on the high end there, and a 0.3 deviation on the low end. Of course, the median forecast is 5%. Of personal income, high estimate of 1% with a low of 3%. PC month on month with a high estimate of 2% and a low of minus 0.1%. Then we have the PCE year on year with a high estimate of 6.8% with a low of 6.2%. Core PCE month on month 5% with a low of 0%. And core PCE year on year with a high estimate of 4.9% with a low of 4.4%. So this is going to be quite key. If we're looking solely at the median estimates, we're expecting a movement downwards for consumer spending from 1.1% as a prior to 5%. Personal income is expected to stay in line with expectation for the median estimate. But the other bits of data are expecting inflation for the PCE, or the personal consumption expenditure inflation, or the index there, to see a tick downwards. So if we look at we'll look at the triggers, and we'll look at some of the other bits of the deviation as to what to kind of be aware of, what to kind of look out for deviation-wise. But I'll quickly run through some of the views then from Morgan Stanley's CEO, Lisa Shallett. She said that with real rates still rising and bond market prospects for 2023 rate cuts fading, stock valuations look extremely stretched, especially if, as we suspect, policy-driven economic slowing will prove an impediment to currently optimistic 2023 earnings estimates, saying that stocks have been overbought and for the time being to sit it out. So what she's saying there is that you have an uncertain future for what the Federal Reserve is going to do. You have, a mix of where we should kind of pause by the end of the year within the restrictive rate, and then that could cause some extra volatility within the markets. It could be an opportunity, or it might not be an opportunity, depending on how you look at it. But there is the fear of the uncertainty of what could lie ahead with 2023, and whether or not 2023 earnings are going to hold up with that. So investors also to add as well, investors are also becoming aware of the Fed's impending acceleration of balance sheet reduction. Remember, we've got about $9 trillion that the Federal Reserve has on their balance sheet, right? Of all the assets that they've bought during the COVID pandemic, go from, I think, about $4 trillion and jumping to $9 trillion within the space of a year since the COVID pandemic, kind of around March, around that time. Also adding that, of course, quantitative tightening begins next month, i.e. in September, putting additional pressure on riskier markets that have benefited from abundant liquidity. Also from JP Morgan, they say they see July consumer spending rising spot 5% and could be on track for a rise of 3% seasonally adjusted annualized rate in the third quarter. So JP Morgan also expecting spot 5%. Then we all more from JP Morgan on August 22nd, saying the Federal Reserve will likely deliver the last of its major rate hikes in September, laying the stage for markets to continue surging in the second half. So what they mean is they'll probably put out their last 75 basis point rate hike that they've been doing, and then might slow that down once they do that in September. But we're not sure yet. We've kind of got to wait for inflation data to come through, and also non-farm payrolls next week too. That's going to have a big influence on money markets and how they try and price in the Federal Reserve, and whether or not the Federal Reserve is going to be quite quick to react to that bit of data and take a decision at the September meeting, kind of like what they did with the CPI print the week before we had the FOMC on that day. So that's one thing that we just got to be aware of from what JP Morgan is saying. So they could be expecting a slowdown of the rate hiking path. Now, so Fed views as well. I think I'll kind of skip. We'll go about 9 minutes. Daily said that if you look at how consumers are spending and getting jobs in large numbers, I don't think we're in a self-fulfilling prophecy mode for a recession. So a lot of Fed members have been saying that there is a risk of over tightening, right, and trying to reach the 2% goal that could lead to a recession. But none of them has said that we're in a recession. They've all said we're not in a recession right now, right? Key thing saying right now. There's still more data that they depend on to kind of use as their own forecasting tool for what to expect and provide that forward guidance to the markets and to their commercial banks in the US and of course globally too. But that's one thing to be aware of is that Fed members aren't looking such as Fed's Daily saying that we're not in a recession at the moment, but consumer spending is quite strong. The New York Fed survey as well that we received said that median 1 year household spending growth expectation among US consumers declined 1.5% to 6.9%. So of course there is fear creeping in of maybe the higher rate of these rate hikes or quick rate hikes having an impact on the consumer spending for the future. But that's going to be quite key. If consumers are feeling that they might be spending less, that could mean that the CPI prints and consumer spending, retail sales could be smaller. But it doesn't necessarily mean that. They could feel like that, but they might still be spending a lot of money or might be spending a lot on goods and services. So, kind of take that with a pinch of salt with that there. Now, the current sentiment as well, Jackson Hole Symposium, of course, we have that today with a load of Fed speakers, of course, with Fed's Powell as well. So we've got Fed's Harker, Fed's Bullard, Fed's Bostic, we've got Fed's Mester, of course, Fed's Powell at 10 a.m. Eastern Time, who was going to be speaking and talking about where they expect the Fed probably where they expect inflation to end up next year, or whether or not we need to get to a certain amount by a certain amount in the restrictive territory of interest rates. But that's causing a whipsaw in the market expectations, whether or not we get a 75 or 50 at the next meeting. So the key things, that people are going to be quite fearful of is that whether or not the Federal Reserve looks for even bigger rate hikes or is even more hawkish than already expected. People already kind of expect them to kind of, talk about a 50 to a 75 basis point hike. So if they go even higher than that, that could potentially cause trouble for the stock indexes and be, could have some positive reaction for the dollar. But if we go the opposite way, where they become dovish or slightly dovish for some reason, and they say maybe we need a 50, or Powell says, if he says that maybe we need a 50, or maybe we need to kind of cut back or have a little drawdown on our rate hiking path, and that could cause the S&P to fly up if there is if there isn't a need for aggressive rate hikes, and the dollar could see it, have a detriment, could experience a move towards the downside as one of those things. But the key thing being, you're going to have a lot of the comments coming before Fed's Powell speaks that could set him up for the rest of the day ahead, but from 10 a.m. Eastern time. So that's the key thing that's on the mind of the markets at the moment, is the Jackson Hole Symposium. Are we going to be even more hawkish, or are we going to be less hawkish? That's quite a very key thing for the current sentiment of the market. Then, if we look at the prior release, actually, what I want to do is get a video for you. It's here. Okay, hopefully you can all see that. So this is the last consumer spending report that we had. I'll play it here. This is about maybe 4 seconds after the release came out. So it wasn't a very strong or quick move. But as I said, 4 seconds after the release had occurred, this is what we've seen the reaction. So the dollar yen had seen a move towards the upside. S&P didn't like it. Bond prices didn't like it, as of course the expectation for a higher rate hike or stronger rate hike at the next meeting. And gold didn't like that either. Remember, intermarket correlation. If the dollar goes up, gold, usually goes in the opposite direction, particularly with these short-term reactions. We kind of skip forward, and so there wasn't a very. See here, there was about a 25 tick move towards the downside on the S&P 500, but the currencies had experienced a much stronger reaction, and so did gold compared to what we'd seen in the past. The reason why I didn't do the release last time is because of how it performed in the past. We didn't see too much of a reaction from the whole market overall, or currencies. So that was how it reacted there. I'll kind of give a quick pause. Yeah. All right. Let's close that. Let's get tick strike running. And we'll look at the deviations too. That's one thing I want to do. We've got about 3 minutes left. 3 minutes. All right. So this is how the markets reacted in the last time. So we have the S&P 500. Again, as said, 25 ticks down. Then we had seen yes, I need to get that there. Don't want that out of the way. Let me bring that up again. Here we go. So yeah, so here we go. So as you can see, the currency pairs, there was a bit more of a reaction from the markets. Now the key thing being is that if we get much better than expected data overall, then you would expect a positive reaction from the dollar. As said, around if we're looking for around a 0.5 deviation at least on consumer spending, and then and also for personal, that's either way for consumer spending. And then for the PC price indexes, if you want a stronger dollar, you'd want the data to come in higher than expected for all of those bits of data. Or most of the bits of data come in higher than expected to see a stronger, potentially see a stronger dollar. So what we can see here, so it was we had gold had seen a bigger reaction compared to last time, and also the currencies too. So these are the three big movers I had seen beforehand. Okay, we've got about 2 minutes, or about a minute now. So the charts that I'm using, as you can see, yep, here we go. So I've got my 2-year bond prices. I've got my dollar yen, got the S&P 500. Those are going to be the ones I'm going to kind of keep an eye out for now. Hopefully that kind of makes sense for everyone. So if we do get a much better overall reading for the consumer spending data, where PC price indexes are also higher along with consumer spending, that could lead to an appreciation in the dollar. Whereas if we get the reversal of that, where we see PC price indexes coming in line with expectation or lower than expected, then we could see a movement towards the downside for the dollar and appreciation on the S&P 500 as a possibility. Right, 10 seconds. Still waiting. go here. It's going to go down. Okay, market's a bit choppy here at the moment. Spot 2 for the personal income, lower than expected. 0.1%, 0.1% lower than the forecast of 0.5%. We have the PCE price index year on year, 6.3%, 6.3% lower than the forecast of 6.4%. PCE price index month on month, minus 0.1%, minus 0.1% lower than the forecast of 0%. Core PC price index year on year, 4.6%, 4.6% lower than the forecast of 4.7%. With real personal consumption month on month for the US, spot 2% lower than the forecast of spot 4%. Core PC price index month on month, spot 1% lower than the forecast of spot 2%. Wholesale inventories month on month advance, spot 8% lower than the forecast of 1.4%. Real US retail inventories ex auto advanced, spot 4%. US advanced goods trade balance minus 89.06 billion, minus 89.06 billion, higher than the forecast of minus 98.45 billion. So, worse data overall. That's, well, there we go. There's reaction. So, dollar, as I would expect to go down. The S&P 500 also went up. Bond prices have gone higher. Okay. That means if bond prices go higher, then that means the yield has gone lower. There we go. Let's check gold as well. Let's see what you doing, gold? What you doing, son? All right, what we got? Gold going higher too. All right. So, yeah, like I said. Okay, there we go. All right. So, you see how the markets tried to trade that before the release had even come out, and then the market, the dollar was kind of trying to go in that direction anyway, but you could kind of see that with the S&P 500, there was a bit of a mixed reaction at the beginning on that first minute candle. Now, if you enjoyed what I'd provided for you here with Macro Ace, then you can definitely give us a follow, which bring it up. Oops. Yes. So if you liked what I'd provided for you and you want to keep an eye out for the next release that I do, or understand what to do, understand what to expect for the rest of the week, then you can sign up to the Macro Ace mailing list here, which I'll put in the chat for you. Okay, there you go. That is the mailing list. Now, in that mailing list, you get access to the deviations for the economic releases that we'll be covering for that week. You also get the week ahead preview, what to expect in the Asia session, the European session, the US, a summary of the weekend news, and also the links to the videos or the live streams that I'll be doing in the upcoming week, right? So that's what you'll get in that email, which I send once a week on a Sunday, for you guys to have a read of and prepare yourself for the rest of the week. So you can sign up to the mailing list, jump on that, and hopefully enjoy the benefits of it. And of course, we were looking at Financial Juice, the website. That's where the data came out here in real time. You'd seen how the markets reacted to the data. And then we'd seen, as said, of course, you had the voice going off as well, the text here as well that you'd seen here, that going off as well. Now, the key thing is that if you're a trader, you're day trading or you're scalping, there's a key thing to kind of keep an eye out for these short-term bits of volatility and bits and these things that are going on within the market. So it could be causing these like flash moves that are occurring. So with Financial Juice Pro, you can already see somebody saying, what is Steve Chambers saying? What is the cost? Well, Steve, we have a 7-day free trial for you to have a look at it for Financial Juice Pro. Have a little play with it, kind of get used to how using a live voice and text service. This is the level of access that investment banks have, right? They have access to all of this to manage the trades, capitalize on potential trades, or adjust their strategies or whatever it may be. But this is what investment bank uses. They have a live voice and text feed service that they use, and I've put that in the chat for you for the link. 7-day free trial. Have a play with that. I think it's usually the usual price is per month around $99. But as said, have a 7-day free trial. See how it goes for you, and yeah. Oh, the newsletter. Oh, the newsletter is for free. the newsletter. Yeah, it's for free. You guys, I've got to make sure. Yeah. So yeah, no need to pay for anything for the Macro Ace mailing list. It's free. Don't worry, Steve. I got you back. So that's Financial Juice Pro that you can sign up for. And at the same time, with the live voice and text feed and the economic releases, there is the Tick Strike app that we have here. All these lovely like blue and red colors that you have. Of course, you can kind of change that. It doesn't have to be that. But Tick Strike, if you guys are not familiar with what Tick Strike is, Tick Strike allows you to listen to the amount of momentum in either buying or selling that is going on within an certain instrument, or maybe a set of in an asset or assets. If you're looking at it, maybe you're looking at all the currencies, maybe how the dollar is doing against all the other currencies, whether it's taking a hit. Like we can kind of see a bit of selling going on here. So Tick Strike, let's kind of put it in a quick way and why you're seeing all these numbers. So Tick Strike, as I said, allows you to listen to order flow and the momentum behind the amount of buying or selling that there is going on. And you have your visual aid, and you also have an audio aid too. Now, of course, I've turned the audio off, but if I were to turn it on, you would hear a ticking sound or whatever sound that you want to, kind of switch it to, that you can have a play around with. And also this number here, well, the numbers that you can see. Now, what this represents, let's say like a slider, okay? So 1, that's when the ticker is the most sensitive to market movements. So when there's a little bit of buying or selling that's going on and it matches the trigger for Tick Strike to go off, then Tick Strike will go off as well. Now, if you raise that level all the way to 15, then that means that then all the way to 15 is the least sensitive to market reactions. So only when you see a big swing or big move of momentum in the market or the asset or an instrument or whatever you're looking at, only then will Tick Strike go off if it matches that trigger there. But you can kind of chop and change and set that wherever you want to set it. There's also a 7-day free trial of Tick Strike as well that we want to provide you there that you can have a little play around with. Remember, with Tick Strike, there are, if I bring it up here for you, there's loads of things that you can kind of do with Tick Strike. So your Forex, you got your cryptos, you got your futures, you've got your stocks, your ETFs, you got your internals as well, with your VIX and your ADD, you've got that there too. That is what you can look at, kind of chop and play around with as well. So the 7-day free trial is there for you to have a look at and a play around with. Again, as kind of said, or might not have said this, but I've said this in previous streams, is that a lot of traders, it's, scalpers or day traders, those are the kind of guys that will kind of use this to manage that risk or capitalize on potential trades. But again, have a little play with it, see what kind of works for you. And then, as I said, there's a 7-day free trial for it. And if you enjoy it, then great. If you don't, let us know. Give us an email. Tell us why. And then, of course, we have unusual activity. Okay, so unusual activity, right? And if you like trading unusual volumes in activity in stocks, then you can join the free beta test group of our new service that we have, which I'll put the link here. So, not only stocks as well, but you can look at currencies. Now we've brought our crypto too, so you can look at the unusual volume activity in crypto. Again, this beta test, we're beta testing it. It's free at the moment, so all your comments and appraisals or criticism is welcome to make the product better. for you guys. As I said, it's free. So the link is there in the chat as well for you. And then I'm nearly done speaking, guys. Don't worry. I'm going to shut up and read through some of your comments. Then finally, of course, if you like this video, don't forget to subscribe to the channel, like the video too, share with your friends as well, and fellow traders, and thinking, oh my gosh, who is this dude, right? Tony. He's got all this information, knowledge, just spread it, share. Yeah, spread it, share it. But thank you very much for listening. You can also follow me on, or follow us on Twitter as well. Macro is there. The link is there. And I am done speaking. I'm going to read through some of the comments that you guys have kind of posted through as well. Just kind of see what we had. We'll kind of keep it short too. Sarek said, what chart are you using? Steve Chalmers said, it is cute how you say spot for a period or dot. It's, hey, I mean, that's kind of in my blood now. Whenever, when I used to say economic releases, or when I say economic releases, I say 6.5 rather than 6.5. Kind of just feels easier to say spot. But thank you. That's the first time I've heard that. What else? Great. Gary says, thank you, Tony. Time well spent. Francois Dame says, I have lifetime and don't regret at all. Best service. Sarix, do you ever want to call one-to-one calls with people? I have not done that. But you do have my email address. Anyway, that's something to kind of discuss further. I'll put my email address here anyway. Email is the best way to kind of contact and kind of discuss. What else? All right. Well, thank you very much to everyone who joined me. Enjoy your Friday. Hopefully, you kind of if you're in the UK, you're kind of enjoying the mix of the heat and a bit of rain. Today it's kind of nice and clear. Actually, no. Look outside now. It's all it's the UK. It's all cloudy again. All right. Sarix, I'll get back to you via email. Do not worry. If you pop your email here, actually, and then I'll kind of just copy it in and we'll go from there. All right. Thank you very much. Enjoy your weekend and your Friday, and I will see you guys next time. Don't forget, if you sign up to the Macro Ace mailing list, you get something on Sunday during the day.